The Group of Seven cuts rates, China hikes, and the kamikaze debt bomb signals the end of the carry trade. Most industrialized banking leaders are pumping money into the system as a subprime debt crisis spreads around the globe, recently infecting the German bank Landesbank Sachsen to the tune of $4 billion in bad debt. But China has the opposite problem, with too much money sloshing around the Middle Kingdom. 2 days ago, China hiked lending rates to stem a persistent bout of inflation. And all the while, those on the wrong end of the Japanese carry trade are going down in flames. The carry trade is when a money manager borrows at low interest rates, commonly in yen, at 0.5%, and buys higher yielding assets in dollars, euros, or some other currency, like the Australian dollar. That's fine as long as the cost of borrowing yen is stable or falling, and the higher yielding assets are worth the risk. In light of the subprime meltdown, those two assumptions are no longer valid. 2 months ago, the yen was at 123 to the dollar. On Friday, it climbed to 111. Currency volatility is bad news when you live on a steady diet of cheap money. But hey, costs are up all over. Federal banks around the world are suddenly moving interest rates, which in turn causes massive fluctuation in exchange rates. JP Morgan Chase & Company's index of volatility on options for the most traded currencies hit an 8-year high mark of 13.4% last week. Things are so bad, those caught on the wrong side of the trade, that Bloomberg is reporting that John W. Henry, owner of the Boston Red Sox, lost $479 million since November. My guess is that Big Papi will be a Yankee next year. The good news for those on the short side is that the unwinding of the carry trade has a long way to go. Excessive liquidity bubble ends with a body or two. Think WorldCom, Enron, Tyco, and the like. I think I found the loser in the Japanese subprime category. It's called Oryx. The $18 billion company is a complicated Japanese firm that is 80% owned by Yankees or other Gaijin. Oryx borrows over 60% of its money at low floating rates in Japan while investing in now questionable products that return higher yields. Over the past 5 years, this strategy, along with one-off sales of assets, had made Oryx a market darling among the free cash flow crowd. Profits had gone from a negative 31% in 2001 to making a positive 126, 51, 63, and 27% over the last 4 years. But just this week, the company announced negative earnings that, if you extrapolate, would put them at a negative 29% for the year. Oryx is getting crushed due to the end of cheap Japanese financing, but the real story is that the Gaijin shareholder base doesn't understand that Oryx is up to its eyeballs in collateralized debt obligations, subprime hedge funds, private equity, and illiquid and obscure offshore assets. For example, the top 5 holders are loan trust beneficiaries, OIFS Cayman Limited Partnership, OIC Limited Partnership, OPE Partners No. 2 Investment Opportunity, and the Mamiji Silent Partnership. I've never heard of any of them. The list goes on to contain $4.86 billion in assets of translucent nature. The total market cap of Oryx is a little more than $18 billion. But wait, it gets better. Oryx has been able to sell it to a New York money man through a top-notch investor relations guy. This guy was fantastic at translating Oryx business model and filings to willing buyers. The internal relations guy just left the company within the last 2 weeks. It is a likely bet that Oryx is going below 30, if not below 3. I'm Christian DeHamer, and that's your 60-second buzz.